Did you know that private equity funds are always close-ended funds? Yes, this is a question that was asked at an interview to a candidate as to why are private equity funds close-ended funds, and the candidate answered in a very appropriate manner. Let's learn more about this. I'm your learning partner Sushila Hariharan, and if you're interested in a career in investment banking trade life cycle all about funds, do subscribe to my YouTube channel where we provide content-centric research-focused videos on topics that enable you to get a entry into the growing global financial market space and get an opportunity to work for some of the largest hedge funds and investment banks across the world. Okay, so what is an open-ended fund and what is a close-ended fund? As we already know, a fund is a pool of capital that is contributed by multiple investors. If it's an alternative investment fund like a hedge fund or a private equity fund, then the pool of investors have to be accredited investors, or else in the case of retail investors, we have mutual funds that are meeting their requirements. So I'm going to focus only on private equity funds. Private equity funds are those funds that take in capital from accredited investors and they invest this capital in startups according to different stages, preferably very early to early stage investing in these companies. Remember that the company's stock is not listed on the stock market, and the private equity fund is therefore investing in unlisted equity, directly contributing capital to the growth and future plans of the company. So, the nature of a private equity fund is completely different from that of a hedge fund. A private equity fund is basically looking at taking in capital from investors, putting it into potentially high growth companies, and staying invested in those companies. So, when the private equity fund puts in capital into the different investee companies, the capital stays invested for long periods of time, literally for something like 3 years, 5 years, 7 years. Some private equity funds exit only even after 9 years, right? So the private equity fund itself is thus looking to making an investment into a company for a time horizon that exceeds more than 5 years. Thus, when the investors are putting in money into the fund, the capital contribution from the investors, while it might come in different tranches, it happens at predefined points of time. Therefore, private equity funds are always close ended funds, and as the name close ended suggests, that they take in capital at predetermined points of time and they exit and distribute the profits to the different partners after a certain period of time. Thus, the private equity funds do not take in ongoing capital from new investors at open-ended point of times or at any continuous basis or at frequent intervals, etc. They are very much close-ended funds because they must take in capital at a predetermined date in different tranches for all you know. But by tranches, I mean it could be spread out over 18 months, 24 months, but it can be only from where the private equity fund has got commitment for the different from the different investors for such kind of capital. Thus, private equity funds are always close-ended funds, and being close-ended in nature, they distribute the profits only at the time of winding up of the fund. Thank you so much for watching in.